aligned issues. And then finally, if you have any questions, please use the Q&A icon at the top of the screen, and we'll try to answer all questions. But if we don't get to yours, we will respond via email after the session. So it is now my pleasure to introduce Jeremy Chalson. Jeremy is a senior business analyst in our business intelligence department. Jeremy works primarily with regional banks supporting their pricing analytics and reporting needs. He's an expert in the industry when it comes to credit risk and loan pricing practices in commercial banking. Now, many of you already know Jeremy and have been on his calls before, so I'm sure you'll enjoy his comments and observations over the next 30 to 40 minutes or so. So over to you, Jeremy.
Well, thank you, Doug, and thank you for all the bankers on the line today. We really appreciate your time. I know it's been a challenging week with the storm. I hope everybody wasn't hit too hard by the snowstorm that we had. But we're excited to be here with you today, and we have some really interesting trends and insights that we plan to share on the CNI market. So just to kind of build on what Doug said, the primary source of today's presentation is our pricing dashboard database, which is the leading commercial loan benchmarking consortium. We have excellent representation across regions, across loan types. For our purposes today, we're really going to focus on the CNI loan market, which has seen some very dramatic trends and evolutions this past year. All geographic data that you see here today, it's based on the location of the borrower. And for apples to apples comparisons, we do normalize risk ratings across the participating banks. So when you see trends related to investment grade loans and other risk-based pricing metrics, we do have this methodology supporting that. As far as our agenda today, we'd like to start with a picture of loan growth, really explore how demand has evolved this year. Certainly been an interesting year with the tariffs, with a lot of geopolitical uncertainty. So we'll explore and really try to get a pulse on how borrowers feel about all the volatility in the market. We'll then explore pricing trends. So we'll illustrate trends in loan spreads. We'll look at that by risk grade, by geography, and really give you some very precise insights into how pricing is taking shape across different market segments. And then finally, we'll look at various trends in credit risk. Certainly, there's been definitely a lot of changes with that from that dimension as well. We're seeing some new pressures in the economy, a lot of uncertainty. That's raised concerns about where the market is heading. And so we'll try to give you a pulse and even some forecasts on where we feel commercial credit is trending and how the next year might look in terms of things like delinquencies and non-accruals and so forth.
Jeremy, hold on a second. I'm hearing that that folks aren't seeing anything. If we could just have people in the chat confirm if they can see Jeremy, and then Jeremy's going to share the presentation. Okay, I do have people saying that they are. So, yep, can see slides and Jeremy. Okay, I'm sorry. We just had two comments come in.
No worries.
So, okay, sorry to interrupt you.
No, appreciate that, Renee. So hopefully all of you can see this slide and this poll that we're about to launch. Before we really dive into the results, I did want to get just a pulse from the audience on how you feel your bank's commercial loan growth is shaping up for the new year. Are you hoping to expand the balance sheet? Are you projecting sizable growth? Are we looking at another kind of moderate expansion like we've been seeing the last couple of years? Or with all of the uncertainty and volatility in the market, are you trying to hold steady and reduce the balance sheet? So Renee and Doug, if we could launch that poll, we'll see if we can get some feedback from the audience.
And for folks on the line, in case the poll didn't show up on top of Jeremy's screen, also check your chat.
All right, Jeremy, I'm watching the results come in now. And as Renee said, if it disappears from your screen, check the chat window. All right, so in terms of the responses around projections for commercial loan growth into 2026, it looks like we're just short of about 2/3. It seems like we have a consensus are forecasting moderate expansion, so low to mid single digits. And then The rest of the group, which is about 40% or so, is kind of evenly split between strong growth, but you do have about 20% of the respondents that are not expecting a lot of growth this year. Jeremy.
That's not too surprising. I definitely think there's some cautious optimism in the market, if that's the right way of describing it, where there is some momentum. I know on the earnings calls, banks are expecting to see some growth, but certainly that's been tempered by some recent economic trends. So let's take a look at the actual results in terms of growth. Or actually, before we do that, I do want to set the stage with some economic context and really just describe some of the broader forces that are shaping the commercial loan market right now. And I think those will provide a lot more color too into the poll results. So far, the economy really has defied some of the more pessimistic forecasts. Just earlier this year, there were several economists that were projecting a recession because of the trade policy volatility, because of price hikes, and so far, the economy really has been defying those forecasts. We've been seeing GDP accelerate over the last few quarters. The fourth quarter projection, according to the Atlanta Fed, is actually north of 5% as of today. So really seeing some very robust expansion in growth. Now, I do want to qualify that by saying the headline number is a little bit misleading. There are what you might call some technical quirks in terms of the GDP results, things like really large swings in the trade deficit can cause some volatility and inflate that number. The real economy is perhaps not quite as strong as that number would lead you to believe. We're also living through some very significant structural shifts right now. We have more political risk, louder populism, much choppier headlines in the financial market. And that effect on businesses is that confidence is eroding. If you look on the right-hand chart, this is from the NFIB. This gives a pulse on the average business's outlook for economic expansion, for whether or not they're going to expand operations. And this metric here measures really kind of uncertainty in terms of if they don't know answers to specific economic questions, it registers higher on this index. Business uncertainty is still very, very high. It peaked around the time of the election, but it is still well north of the historical average. This uncertainty that we're seeing in terms of the C&I market is the biggest challenge that we face in terms of growing the balance sheet and even projecting where credit risk is going to head. Uncertainty keeps utilization rates down. It can force banks to incentivize new borrowing with increasingly thinner spreads. So there's a lot of potentially negative ramifications for an economy and a loan market where we really don't know how the next couple of quarters are going to shape up. That doesn't mean that banks can't prosper in this environment, but uncertainty really is our biggest barrier for revenue growth in the months ahead. We can really see how uncertainty is impacting C&I growth and C&I demand on this slide. This is from the Fed's H8 series, and I do want to just point out a few changes that the Fed has made to the series. They have stripped out loans to non-depository financial institutions. There were a couple of other seasonal adjustments that they've made. So some of the big swings that you see in this trend, there are some artificial changes, if you will. But the direction of growth that we're seeing here really is indicative of the true market. There's really a stark contrast between the first half of the year and the latter half, where in the first half, that was really defined by tariffs. So what we saw in the first half is that growth did accelerate, C&I growth that is, because a lot of customers were loading up on foreign goods and pulling forward their inventory build ahead of tariff implementation dates. That effect, though, was unfortunately transitory. In the second half, we are not seeing nearly that same pace of C&I loan growth. What we're hearing from the banks that we work with, even some customers that we've spoken to, is that the uncertainty that's in the market has really had a depressing effect on line utilization rates. It's left customers a lot more hesitant about pulling the borrowing trigger. And the rate cuts that we've had recently really haven't been enough. It's not so much that pricing is prohibitive and that's been a counterweight to loan growth. It's more, again, that just there's a lot of uncertainty that's weighing on demand, and it's really kind of keeping this growth trajectory very, very low. There's also some saturation, if you will, that we're seeing in certain regional markets. So lately, there's been a lot of M&A activity. There's been regional expansion into California, into Texas, into the Carolinas. And in some markets, we're actually seeing the supply of credit outpace demand. So even if these markets are very strong in terms of economic growth, there may be too many banks chasing too few deals. There is still, as the poll suggested that we just had, a sense of optimism in the market that there will be at least some moderate growth in 2026. At AFS, looking at the pricing data, we are seeing commitments grow, but businesses seem hesitant to draw down on those lines as of late. Uncertainty in the market has made banks a lot more cautious as well. Even though we're still hearing on the earnings calls an optimistic tone about bank lending prospects, really we're seeing an increase in risk aversion throughout the market. So these charts measure the supply and demand of credit, so both the sense for whether or not senior loan officers are seeing an increase in demand and whether or not banks are tightening standards on C&I credit. If they're tightening, that dark blue line will be beneath the horizontal axes. And what we've been seeing for a while now, both for the larger firms, the middle market firms, as well as the smaller end of the market, banks have been tightening standards for quite some time, at least since we've had the inflation surge a couple of years ago. So that uncertainty is also causing banks to pull back in certain sectors, to be more selective with certain types of credit. And that too is depressing loan growth a little bit. We're seeing a lot more interest and activity in the investment grade space where more banks are willing to compete for the better credits. But that in turn has created some new pricing pressures. So really uncertainty is impacting demand. It's impacting how banks are assessing and viewing credit. And all of that makes for a very, very challenging loan growth environment. There is, however, one sector that is growing at a very robust rate, and that is the finance and insurance sector, which sometimes is called NDFI, so non-depository financial institutions. Really, it's no secret that private lending, private equity has been booming for quite some time. But what's somewhat ironic is that even though banks are competitors to private credit, they're also funding these same non-depositories and contributing to the boom that we're seeing in this space. If you look on this chart here, you can see that on a year-over-year basis, we were seeing very robust growth to loans in the finance and insurance sector. There was a bit of a slowdown in 2023 and 2024, but that's reflecting just a broad slowdown that we saw across all C&I sectors during that time. In fact, over the last few years, the concentration, the percentage of these finance loans to total C&I volume has been gradually, actually more than gradually, exponentially increasing. So it's a booming sector. We're seeing banks of all size enter this space. Now, this rapid growth, it doesn't necessarily mean there's a problem or a cause for alarm, but when you see a sector or an asset class growing this fast, it does provide one of the necessary conditions for a potential problem. You add to this sector the opaqueness, as well as a couple of high-profile defaults that we saw in 2025, and you can see why it's definitely making headlines in Bloomberg and other financial markets. So it's one that we're really keeping a close eye on. So far, it is performing well. We aren't seeing significant signs of stress, but it has been having an outsized impact on C&I growth rates as of late. Now, as banks look for new pockets of growth, one area that's actually surprised the upside in 2025 is lending to small businesses and professional practices. So here we dissect the C&I growth rates by commitment size range. And what you can see on this chart is that there's been a really robust increase in loans under $1 million in size. So we're seeing a lot of loans to smaller end doctor offices, professional practices, kind of other firms that really might have become numb to some of the macro news that we're seeing, whether it's the shutdown, whether it's geopolitical news. They're continuing to borrow. They are seeing good demand in this space. And what we hear from our clients and the banks participating in the pricing dashboard, that these loans often have very strong cross-sell opportunities. So not only is there demand there, but there's the potential for very profitable, very favorable relationships. Elsewhere, we're not seeing a heck of a lot of growth. The sizes in the middle, which might approximate middle market activity, they've been down for quite some time. We're not seeing a lot of demand in those silos. And the very largest loans, the volatility that you see in growth rates on the far right, that's being driven almost exclusively by the finance and insurance activity we just took a look at. Those loans tend to be very large. The nature of them is such that the borrowers will tap lines of credit short term as they wait for redemptions and investments from their investment pool. But as soon as they get an influx of funds, they pay back the loan. So it's a much more volatile space, and it's contributing to a lot of volatility in the upper end. But the smaller end, we're really seeing much more consistent growth. And in contrast to prior credit cycles, the winning banks, so to speak, the banks with the highest level of loan growth in 2025 actually focused much more on the smaller end and really benefited from the increase in demand that we're seeing from those types of borrowers. And so we can kind of dissect that trend a little bit more if we want to understand what types of credits are contributing to the growth in loans under 1 million. So here we focus just on that size range and look at it by NAICS sector. And a few of these really stand out to me. So the ambulatory healthcare in the middle of the graph, that comprises your doctors and dentist offices. So we're seeing close to 20% growth year over year in that space. Again, a lot of good cross-sell opportunities there. We've heard a lot of banks trying to open up new verticals or niche segments to accommodate healthcare and specific types of healthcare borrowers. So it's one that continues to show a lot of strong demand, even as the broader market is being weighed down by broader economic uncertainty. Same thing with the leisure sector directly to the right, NAICS 713. We're seeing very robust growth in that segment. And it's worth noting, too, that healthcare, leisure, professional services in 812, which would comprise things like beauty salons, barber shops, other local firms like that that you'd see around your town. All of these sectors actually had pretty robust job growth in 2025. So what we see in the commercial space is even more so than GDP or corporate profits. It's the labor market trends that have a very strong correlation and impact on loan demand and loan growth. And all of these sectors in the middle here had very robust job growth in 2025. The national increase in job growth, I believe, was negative in part because of some of the immigration trends that we're seeing. So these sectors are bucking the trend. They have good demand. And again, the banks that are continuing to grow in this environment have focused more on these smaller practices to fuel their balance sheet growth. Now, loan growth is also very heavily dependent on geographic economies. Many states right now, they are facing pressures from tariffs, downturns in immigration, and the AI boom that we're seeing really hasn't been enough of a counterweight to offset those forces. According to some estimates, about half of the US states are sliding into an economic recession where we're seeing GDP and labor market trends being very negative. And analogously, the same number of states are struggling to gain traction in C&I loan growth. So here we have a heat map of C&I growth, where if you are declining or struggling to maintain momentum, you are red and yellow. And if you are continuing to expand, you are the green shades of color. What we've seen is that a lot of the recent M&A activity, coupled with some regional bank expansion into markets like California, Texas, and California, that has actually been causing some pricing volatility in the C&I space. So particularly in California and the Carolinas, there are many more banks entering those markets. There's a bit of saturation, if that's the right word, in those same local markets in Los Angeles, in some of the Carolina metros, and same thing in Houston and Dallas. We're just seeing many banks chasing the same deals. That has had a very significant impact on competition. In these markets, even though they're continuing to grow, we are seeing spreads show much more volatility. We are seeing a downward trend in pricing in those markets. So even the ones that are growing, perhaps they are we're seeing too much credit and too big of a supply in credit that's actually outstripping demand in some of these areas. Probably the question we get most from bankers is centered on line utilization rates. So whether or not we're seeing any meaningful increase in line utilization. The short answer to that question is unfortunately no. We're still seeing line utilization rates really kind of flatline since the pandemic. So what we've seen post-pandemic, post-COVID-19, is really some structural shifts in the ways that companies manage inventory and working capital. You can kind of see here the inventory to sales ratio that we've plotted, which really is much lower than it had been prior to the pandemic. That in turn is keeping utilization rates somewhat flat and somewhat low compared to historical levels. We are seeing commitments continuing to grow. So there are exposure at banks and commitments in certain sectors are continuing to rise. However, some of them are going unused or not seeing much utilization. So again, a lot of this uncertainty that we're seeing in the market in terms of the economy, in terms of price hikes and inflation, it is keeping many borrowers on the sidelines. Again, that's not to say that companies don't want liquidity. They are continuing to take out commitments, so bank pipelines are still strong, but this uncertainty really was a big challenge in 2025. And so as we shift our focus to pricing, I've talked a little bit about some of the observations that we're seeing in the environment, but of course it's more meaningful to hear from all of you. And we're curious right now if you could please provide some of your insight into really how do you see the C&I pricing environment shape up? Is it still very competitive? You're fighting for every deal. Are you seeing kind of a reversion to the mean where it's kind of back to normal in terms of rates and spreads? Or is your bank just being really cautious in terms of not wanting to compete too heavily on price? So Renee, if we could launch this poll, we'll then take a look at some of the pricing trends that we're seeing out there in the market.
I'll give it another couple seconds here, Jeremy, while the responses are coming in. All right, they're starting to slow down. So in terms of the participants' perception of the current C&I pricing environment, kind of have an even split between about 43% feel it's highly competitive, they're fighting for every deal, and about half of the respondents feel it's about normal, seeing rational rates and spreads relative to risk, and then just a very, very small minority are in that cautious category, Jeremy.
That's very interesting. I think part of that discrepancy that we're seeing, or that kind of that bimodal distribution in the responses, is that it's really heavily dependent upon geographic market. And we'll take a look at some of those in just a moment. But depending on where you're located, we're definitely seeing in some markets much higher pricing competition than others. At a national level, at least, if we try to disaggregate the trends in spreads, we definitely are seeing some evidence of pricing competition. So on this slide, we look at loans tied to SOFR up top, and then the loans tied to prime at the bottom. We have the originations on the left and the renewed business on the right. And if you start in the top left here, we are seeing a pretty consistent and dramatic decline in the weighted average SOFR spreads for new loans. It's fell from about 230 bips to closer to 200 bips in the most recent quarter. And I note this is occurring at a time when broader rates, the Fed funds rate, for example, is actually falling. I think what we're seeing here is a basic supply and demand problem. We're not seeing a heck of a lot of demand at a national level for C&I credit, at least right now in this very uncertain market. And that in turn is causing banks to offer thinner spreads in an attempt to stimulate loan demand. Even if you normalize for changes in the risk mix over time and the sector mix, we are still seeing this downward trend in pricing. So it definitely speaks to some competitive forces that are continuing to intensify as a result of this kind of weaker loan demand that we have out there in the market. We're seeing some evidence of pricing competition as well for the renewal activity. So if you look in the top left there, while the decline in spread was not quite as pronounced as the new business, we are seeing very thin spreads for SOFR-based renewals. It tends to average below 200 basis points when you look at it over the last couple of years. One of the things we're hearing from banks is definitely a sense of flight risk, where certain borrowers are trying to refinance in capital markets or other in bond markets where pricing and risk premiums are very, very accommodating and very favorable. So again, the broader uncertainty that we're seeing in the market, private lenders and capital markets looking to kind of put their funds to work, this is making the pricing for commercial loans much more competitive than even it was, and it was certainly competitive a couple of years ago, but even more so than what we're seeing, than what we saw even in 2024. The prime-based activity on the bottom, again, we're seeing for the last couple of quarters for the new prime loans, some negative spreads over the last couple of quarters. That's partly because we're actually seeing more and more banks offer prime loans to larger customers, the less risky borrowers, where they're offering them negative prime spreads. So that's been a phenomenon that's relatively recent. We didn't used to see prime as much in the larger end or the investment grade segment of the market, but that's become a much more prevalent trend that we're seeing. As I mentioned, these spread pricing declines, they do persist even when you normalize for credit risk. And so what we've done on this slide is look year over year at trends in pricing, SOFR equivalent spreads to be exact. So we're normalizing across different indices, taking into account, trying to have an apples to apples comparison across loans tied to SOFR, prime, and fixed. And if you look at the trend on the left, which shows the risk curve as of January in blue, and the kind of the risk return curve in the most recent month as the orange series, we're seeing spreads kind of fall across the risk spectrum, but especially for the loans risk rated investment grade. And so if you think back to some of the earlier charts we had, like Senior Loan Officer Opinion Survey, where we're seeing banks become more risk averse, we're definitely seeing more and more banks chasing the better borrowers and willing to compete much more heavily for the best rated credits. And that's been creating a lot of spread pressure this past year. Proportionately, if you look on the right-hand chart, we're seeing that same pressure for the largest credits. So if you use kind of larger deal sizes as a proxy for risk, we are seeing spreads narrow for the bigger credits as well. The most interesting thing to me, though, is actually in the smaller end of the market. So for loans that are under $1 million in commitment size, spreads actually widened year over year. It wasn't a significant increase, but they did go up. And we'd mentioned before that we're seeing much more demand from smaller borrowers, whether it's doctors' offices, professional firms, leisure firms, those kind of activities. We're seeing demand rise in those segments, and banks are also able to charge slightly higher spreads for those same deals compared to what they were earning just a year ago. So if you really want to characterize which banks have done the best this year in terms of growth, in terms of pricing, it's been those that have been willing to take on a little bit higher risk in the smaller end, but as a reward for that, they're getting higher growth, higher spreads, and certainly not seeing nearly the same competition that we are for the larger investment grade firms. So what I'd like to do now is just slightly switch gears, and I'm going to actually demonstrate how our pricing dashboard, the database and the application that is feeding the data for this webinar, can help you get a sense for some demand signals in your portfolio and help you to really optimize price on your new renewed business. So I'm going to exit the PowerPoint here, and I'm going to go to our pricing dashboard screen. And Doug, can you confirm that you can see the pricing dashboard?
Yes, I can.
Awesome. So this is one of our reports in our pricing dashboard. So for the banks that participate in this program, in addition to regular updates on market trends like we're seeing here today in this presentation, we surface the data for both their bank and the market via a very visual interactive dashboard that's predominantly designed to help them optimize spreads on new and renewed business. So what we have here on this particular chart, it's kind of a post-mortem analysis of, in this case, a sample bank's recent new and renewed activity. So this table here at the bottom, it lists all of the bank's recent new and renewed deals. We can see when they were originated, the current interest rate referring to the bank pricing. But what's really special here is we can look at the characteristics that define each loan, things like line of business, geography, deal size, and so forth, and look at all of the loans for the bank's peers that share those same characteristics. We can look at that pool of comparable credit and derive a specific market benchmark for every one of the bank's new and renew deals. That's what you see market interest rate here. It's basically telling you what your peers or how your peers would price the deal in question that's illustrated on this particular row. So in this example here, the sample bank that we have is earning a little under 5% for a loan that meets the characteristics on the right. But what our application is, with the insight our application is providing, is that actually peer banks would price this loan almost or more than 50 basis points higher than what the bank earns. So this is not noise. These are not modeled spreads. They are very real demand signals out there in the economy that help illustrate exactly how your peers are pricing similar deals and really what customers are willing to pay out here in the market. And what we can do for each loan where we see a difference like this is we can look at the interest income the bank is leaving on the table by pricing beneath the market clearing level. That's what that opportunity column here illustrates. We can sum that across the entire book to really give you a very precise and tangible target that says, should you be able to raise the pricing that you're charging to market clearing levels, this is the annual uplift in interest income that you would receive. Now, we know that it's going to be impossible to always get the market level. There could certainly be valid reasons for why a bank is underpricing in a particular segment, but it's really meant to illustrate or stimulate discussion to show whether or not the bank has a certain bias in certain segments, and just really, again, help you to optimize pricing on all of your new renewed loans. It can really help in this environment too, because what we've heard from a couple of banks that are using this application is that whether they have a really recalcitrant renewal or it's a really tough negotiation on spread, if they can demonstrate with real market data and real market guidance that they're actually pricing much more favorably than the market average, that can actually help secure or win that business of a very recalcitrant or difficult renewal. So there's a lot of ways here that we can help you kind of manage through the uncertainty that we're seeing. And we're all about just helping you understand exactly what spreads the market can bear, ensure that you're optimizing spread on your new renewed business, and where possible, illustrate where your bank might have a bias in one direction or another. In fact, if you look at this chart here in the upper right, where we look at how the bank spreads compare to the market in terms of size segments, the sample bank here being the lighter series. We mentioned there's a lot of competition in the larger end of the market right now. And if you look at this chart, what it tells us is the sample bank is actually earning very good spreads versus the market for the smaller end deals, but it's not quite earning its fair share in the larger end of the space, in the larger end of the market. So it can show you where competition is heating up, where a particular bank might have a pocket of opportunity. And we're all about illustrating, again, these pockets of opportunity, these demand signals to ensure that in an environment where growing the balance sheet is tough, you have all the insight and all the analytics you need to price your loans as high and effectively as possible. One of the filters in our pricing dashboard, and one that we illustrate here back in the PowerPoint, is actually looking at geographic region, so core-based statistical area. So in the poll that we had just launched, where some of the banks were saying, yes, we're seeing competition heat up, others saying that it's been a little bit more rational and normal. I think the reason for that discrepancy is that some markets are much more, regional markets that is, are much more competitive than others. So here we illustrate spreads by some of the biggest geographic markets, both in terms of loan volume as well as GDP, where the blue series is the weighted average spread, and the box shows you the dispersion between the min and the max bank in each market. And what we're seeing across all of these CBSAs, be it Los Angeles, Houston, Boston, is that there's significant pricing dispersion between the min and the max bank. I think what we're seeing here is that, especially with a lot of new regional expansion into California, the Carolinas, and Texas, it's really causing a lot more volatility in pricing trends and pricing profiles, particularly compared to what we saw just a few quarters ago. So a lot more volatility, a lot more dispersion. It is worth noting that in most markets, if you look at the weighted average, it tends to be on the lower end of that bank spectrum. So what that means is that the banks that control the most market share in areas like Los Angeles or Atlanta or Miami, those banks tend to price well beneath the median bank. So there's definitely a very strong degree of price sensitivity and elasticity in these markets. The exact levels of competition, the average spread and rates that we see, they can and do vary by market. But definitely, if you're looking to expand market share, there is usually a cost in terms of the spreads that you can earn in those particular geographies. Now, with interest income being challenged by some new pricing pressures, there's definitely been a renewed focus on fees. I hear that all the time from the banks I work with. We're really trying to introduce more discipline in terms of how often we collect fees and the levels at which we assess fees. If you look at the trend here, the orange series gives you a sense for the fee pricing, and the penetration rate is the dark blue series. For C&I loans top of the house, good news is that in 2025, there was an improvement in fee collection, both in terms of how often banks are getting fees and the levels at which they're assessing them. A lot of noise, at least in the long-term trend, much more volatility and oscillations that we're seeing for spreads. And one reason for that is fee dispersion isn't quite as easily explained by factors like geography and industry. We don't see quite the same correlation as we do with spreads versus those factors. I do think that's an opportunity for banks to really kind of analyze demand signals by sector, by geography, to see what levels or what fee levels certain sectors can bear, whether there's a significant difference between healthcare loans and other types of credit, whether we're seeing some dispersion in size. And actually, to that point, we can illustrate here some dispersion in fee pricing that we are seeing across different levels of the market, levels meaning different sizes of loans. And on this chart, we bucket the loans in terms of less than $1 million, 1 to 25 million, and the larger in activity on the far right. And what we're seeing here is for these smaller borrowers, definitely a significant rebound in the fee level. So that left-hand chart really seeing the average fee level rise for these smaller end borrowers. There's really a misconception out there in the market that fees can discourage growth or drive away potential borrowers. Sometimes they're waived as part of renewal negotiations or when booking new loans, but that's really not the case. If you recall, this less than $1 million range, seeing very good growth, we're definitely seeing much more demand from these smaller practices. And banks are able to charge higher fees without discouraging demand in those segments. So it's a really fascinating trend and one that I think can be explored and applied to the larger loans as well. We at AFS don't see significant differentiation in fee pricing for new loans or renewals for loans over $1 million. Again, it seems to be kind of a blanket fee level that is applied for some of the larger end loans. But again, if you really apply some of the dimensionality that we have in the pricing dashboard, looking at these trends regionally, by sector, by size, I do think that certain levels of the market can bear higher fees without discouraging growth. In fact, what we've looked at in recent months is loans with fees and loans without fees, and tried to assess whether or not the loans with fees had higher or lower spreads than the loans without them. And maybe contrary to your intuition, what we see over time is that actually the loans booked with fees tend to have higher spreads. That might be because they have a smaller average deal size. They might be a little bit riskier. But again, I don't think fees are prohibitive in terms of securing deals or growing the balance sheet. So a really important revenue driver that should not be ignored, particularly in this environment where we're not seeing quite the level of growth that we'd like. Now, one of the concerns heading into 2026 is that there is some worry about how credit quality is going to respond to uncertainty and as price hikes work their way through economic channels, to broader geopolitical uncertainty that seems to be in the news all the time. A lot of the tactics that companies use to delay the adverse impact of tariffs unfortunately have run their course. This is going to mean probably more narrow profit margins for the average company, particularly those that don't have the capital to really invest heavily in AI to offset some of those costs elsewhere. And really compounding a lot of fears in the C&I space is that we've had in 2025 some high-profile bankruptcies in the finance sector. that led Jamie Dimon to infamously coin the phrase cockroaches, meaning that there could be many more hidden and negative issues lurking beneath the surface. The good news is that those cockroaches, if you want to call them that, if they do exist, they really haven't materialized just yet. In fact, in the C&I space, credit quality improved overall in 2025. On this chart, we're looking at loans that are risk-rated special mention, meaning they're teetering on potentially defaulting or becoming problem loans. We have the classified rated borrowers, so the worst rated in terms of obligor risk rating. And then we also layer in actual delinquencies and non-accruals onto this series as well. And if you look at kind of the stacked bar, which is the sum of all of the adverse credit events in the C&I portfolio, thankfully that trend has not shown a clear upward trajectory. In fact, year over year, the total amount of loans that are special mention, classified, delinquent, or non-accruing has slightly improved over that period. I think part of that is because banks have become slightly more risk averse. They have tightened standards on business loans. I'd expect this trend, this improvement to continue, mainly because with the rate cuts beginning to work their way through the economy, that should help improve debt service coverage for some of the stressed borrowers in certain sectors like leisure and even in the commercial real estate space in certain segments in that part of the portfolio. So credit quality for now remains sound. The only area that could become a potential risk, and I only say that because it's so opaque, is those finance loans that we had analyzed a little bit earlier, where just because of the magnitude of the growth and concerns about how interconnected these loans are to other risky asset classes, that could transmit risk via those channels to commercial banks. Again, I don't want to raise any alarm bells over that right now. Not seeing any clear stress in that sector. That is the one area to really keep your eye on. But in the rest of the market, at least at a headline level, at top of the house level, credit quality in the C&I space is still very, very good. Now, one way that we can help forecast the trend in credit quality over the next several quarters is to potentially look at how labor market trends influence and correlate with problem loan ratios. And again, what we found really across all commercial KPIs, be it growth, be it non-accruing loans, there's a very strong impact in terms of job growth and unemployment rates when you look at sector trends and the KPIs in the C&I space. So what you see here on the scatter plot, we looked at some of the biggest sectors in the economy: manufacturing, healthcare, the information industry. And what we've done is we plotted each sector's year-over-year employment growth according to the government on the x-axis, and then we correlate that with each sector's non-performing ratio. Non-performing here meaning you're on non-accrual or you're past due over 90 days. And there's a moderate correlation, moderate inverse correlation, in which the sectors with the highest levels of job growth tend to have lower non-performing loan ratios. So for sectors that we project sound job growth, such as healthcare and leisure, which are continuing to grow, those sectors will see a positive impact on problem loans, whereas industries like manufacturing, which is currently in recession, the information sector, which includes things like motion pictures and some other areas that are a little bit more stressed, and we're not seeing a lot of job growth. For sectors that are rapidly shedding jobs, there could be an adverse impact both on loan growth as well as credit quality. So this is really a kind of a neat picture to say, well, if we're trying to forecast where the market is heading, it's always helpful in the commercial space and the C&I space to look at labor market trends as a predictor for where the C&I KPIs are headed. And as we wrap up here, I just wanted to take one last poll that might seem a little bit different than the ones we are looking at, but with really all of the talk right now about AI, and certainly you can't, it's impossible to escape that discussion right now. I'm curious for the banks on the call, really kind of where they are in their AI journey. Are they just beginning to implement some of this technology? Are they using it for things like security prevention and customer service? And I can say here at AFS, we're really excited about this space. We're looking to embed some of this technology into our pricing services and our other products. So curious to hear how other banks are proceeding with that journey. And you can select more than one option on this poll. Curious to hear your priorities in terms of deploying this technology across your enterprise. So Doug and Renee, if we could launch that last poll, we'll see where the market is heading on that front.
Okay, Jeremy, the poll's been launched. We'll give them a few minutes to respond to the questions. And again, they can select more than one option here. Looks like they're kind of slowing down. I think the most interesting thing, Jeremy, is that only 36% noted they're just beginning their AI journey. So I think that's significant improvement than even just say a year ago. And then the next highest response was for using AI in security and fraud prevention, about 30%. And then kind of an even balance, 13%, 17% for credit risk or Gen AI in operations. And in terms of price optimization, no one is deploying AI for price optimization at this point anyway, for this sample.
That's fascinating. Well, the good news on that front, Doug, is here at AFS, we are looking for ways that we can use machine learning and other techniques to actually improve bank pricing. We're excited to share that we are looking at using things like regression analysis and classification models to help estimate spread for different loan types. I think things like clustering and those algorithms really trying to organize borrowers in ways that we don't usually think about. So beyond things like industry and geography, but really trying to organize them along behavioral lines can be really powerful in terms of setting price, measuring demand. And again, we here at AFS, we're continuing on that journey along with the rest of you. But in the months to come, look for some more news from us on how we are continuing to explore these trends and this technology. And we think it has a lot of power to improve and facilitate pricing decisions at banks. And so I know we're coming up on the top of the hour. We will open it up for a few questions if there's some on the line, but I do want to say just thank you to all the banks that took time out of their busy day to attend this webinar. A special thanks to the banks that participate in the pricing dashboard and continue to contribute to these analyses and these webinars. We really appreciate your business. Certainly, if you're interested in learning more about this tool or in the types of solutions that we have here at AFS, you're welcome to contact either Doug or myself. But Doug and Renee, I think we'll open it up. We have a few minutes left to see if there's any questions from the audience.
Doug, I don't know if you see any questions. Right now, I'm not seeing any in my window, but would encourage folks to use the Q&A button at the top of your screen to submit your questions. Doug, looks like maybe you have one.
I do. Jeremy, there's a question here. I think it's referring back to the growth by state slide and commentary you had around there. And the question is, what industries outside of finance are you seeing growth? Any impact benefit from the big beautiful bill?
So both are good questions. So for the first one, in terms of sector exposures, now that can be nuanced by geography as well. So for example, in Texas, where you're seeing a lot of that growth, there has been a rebound in energy lending in some of those markets. At a national level, the ones that we see in many states are healthcare and leisure, which really have seen some pretty strong growth, particularly in the smaller end. And again, it's not surprising. Those same industries had really robust job growth as well. That's the key. If you're seeing a lot of job growth in the industries, it tends to translate into more demand for growth. In terms of the big, beautiful bill, I think the impact, it might take a few more quarters to shake out in terms of what we're seeing in terms of loan growth. Certainly, the regulatory environment, the political environment, it's been more pro-business, which can impact the growth that we're seeing. But I think the biggest driver of loan demand right now and loan growth across the country, again, is just really the uncertainty we have around inflation, tariffs, kind kind of the price pressures that we're seeing in the economy, more so than the big, beautiful bill, more so than these other macroeconomic factors. That uncertainty really is the major driver, and unfortunately kind of a negative driver of growth that we're seeing in the commercial loan market.
I am not seeing any other questions at this point. I know we're approaching the top of the hour here. I'll stall for another 30 seconds to see if any others come in. But as we do that, that's going to wrap up our webinar. I want to certainly thank Jeremy for sharing his insights and observations on the state of the market. And thanks to all of you, certainly, for joining us. Certainly have a good day, and give us a call or send us an email if you have any questions. I think with that, we can wrap it up and wish everyone a good afternoon.
Thank you, everyone. Take care.
Thank you.